My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back, folks. Today we've got a special guest zooming in, who is a very interesting gentleman. Dan Brisse is not only an amazing real estate entrepreneur, a syndicator, multifamily property specialist, rock star at raising capital, but he also comes from a very interesting background of being a professional athlete in those wild and crazy X Games, those extreme sports. So Dan, welcome to the show. Looking forward to chatting with you and finding out your secret sauce and what got you into real estate. So welcome to the show.
Thanks for having me. Excited to be here.
Okay, I just got to know, man, you were rock and rolling as a professional athlete in a very exciting sport in the X Games. I think you're in snowboarding, if I'm not mistaken. How did you even clue into, and why did you clue into real estate over 10 years ago?
Yeah, during my snowboarding career, I was lucky enough to meet some of my heroes, the guys who I looked up to when I was in Minnesota. I grew up in Minnesota, transplanted to Salt Lake City, where most of these pro snowboarders lived. And I got to know these guys as my career took off. And when my career took off, theirs were call it 5, 7, or 10 years ahead of mine, and they were winding down. And when I saw their careers wind down, I saw the destruction that it brought to them and their families. And, it was drug addictions, it was suicide, like they lost their identity of who they were. And it scared me. So
Plus the
2012, I started reading
the
every.
financial side of things, I would imagine too, kind of dried up quickly
Yeah.
for them. Yeah.
Yeah, losing their homes, losing everything. Yeah, exactly. And so started reading every book I could get my hands on in relating to what to do with the money I was making and how to, help save on some of the taxes that I was getting hit with as an athlete. So those were the two things that really got my attention was the destruction from these guys and then, cash flow and depreciation.
Cool. So how did you jump into multifamily while I'm assuming you were still a full-time professional athlete?
Yeah, with the books that I was reading and the education I was getting and all of the podcasts that were coming out at the time, I was attracted to the Rich Dad Company, Robert Kiyosaki, Rich Dad, Poor Dad, all of his series, and then Ken McElroy, MC Companies wrote a book called The ABCs of Real Estate Investing, and then I got hooked up with the Real Estate Guys radio show, and I started going to their 3-day seminars and just started taking all that information in I possibly could. And within a couple of years of studying, I bought my first duplex in 2012 or 2013. And that was kind of the beginning of it. I saw cash flow, I saw some depreciation, and started to find ways to create multiple streams of income, which, that was a real eye opener for me. Was making money as an athlete was a dream come true. And I was, tickled pink to have this career take off. And then I realized how much I still had to work. I had to ride. And when I stopped riding, the income stopped.
Yeah.
And so I was looking for assets, looking for investments that paid me no matter what I did, whether I worked or didn't work. So that was very eye-opening, midway through my career. And I saw I had probably a 5 or 7 year run before everything wound down. So I would snowboard all winter. And then in the summer, I'd spend all my time, work, learning and educating and going after and buying new deals and adding to my portfolio.
So what did that portfolio look like by the time you wound down your snowboarding career?
Well, by the time I wound it down, I was very into real estate. I probably had 500 or 600 doors.
Wow.
Probably had done 3 or 4 syndications already by that time.
As a
Um,
GP or as an LP in those syndications?
yeah, as a general partner,
Oh, okay.
probably had done 4 or 5 LP investments as well.
Mhm.
But yeah, the by the time it all wound down, I was very heavily into real estate, and everyone in the snowboarding industry already knew it, including all my brands. So it wasn't something I hit it pretty well in the beginning, but after you start publicly bringing deals out, word gets around, and people talk, and pretty soon it's like, hey, Dan's rolling out a 240 unit investment opportunity, and he's raising capital, and by that time people start to talk.
Very cool. So would it be fair to say that your your syndication business, your equity group was already up and running before you retired, and then you jumped into it full time once you pulled the plug on snowboarding?
Yeah. Granite Towers Equity Group was already founded before my snowboarding career ended. And it's owned 50-50 between one of my best friends I grew up with and myself. Just the two of us own the company. But I would say, for 5 years or so, I did a duplex, I did a nineplex, I did a 24 unit deal, and we did a partnership and did 28 units. So there was some work and some investments that were done prior to Granite Towers, but by the time my career wound down, yeah, Granite Towers was in full force.
All right, very cool. So transitioning into syndications, you and your partner these days, your general partners on your deals, what does that look like? Are you typically working with a number of other GPs on a project and bringing one piece of the puzzle to the table as your specialty, or do you guys kind of do it all?
Yeah, at Granite Towers Equity Group, we run the whole gamut. So we're out finding the deals, building the relationships with the brokers, going through due diligence, closing the deal, taking care of the business plan, hiring the property manager, doing the day-to-day asset management. We do it all from beginning to end.
So all the way from, yeah, the whole bit, the underwriting, the marketing, the lead
Yep.
gen, the raising capital, the management, the overseeing. Yeah.
Yep.
Okay, that's a lot. So back in the beginning, if a number of years ago when it was just you and your partner, how did you manage all of that stuff yourselves, and what does your team look like these days, Dan?
Yeah, you bet. So one note I should mention right out of the gate is we still use third-party professional management. We just asset manage the property management company. So
Yeah, you
when
you
we,
manage the managers. I completely get
yeah,
that.
that's exactly right. But in the beginning, it was Mike and I doing everything. Our first syndication was a 45 unit deal in River Falls, Wisconsin that we purchased in 2017 or early 2018. And for that property, we went out and built the relationships with the brokers and got to know them. We went out and toured properties, and we did all the initial underwriting. We built the investor package that we used to share the deal and the investment and why we liked it.
Mhm.
We set it all up via MailChimp and brought the investors into a investor presentation via Zoom. We raised all the money. We used the team members, obviously, to create our SEC docs for our PPM and operating agreements. So we obviously are SEC compliant with that part. But I mean, really, we did it all, and it was just Mike and I. And now our team consists of 8 full-time team members. We have a full-time accountant, full-time asset manager, full-time director of relations for investors. We've got a couple full-time virtual assistants that are out in the Philippines that help us with a lot of the initial underwriting and day-to-day monitoring. And then we've got a new guy that's coming on out of college that is kind of jack of all trades. We're figuring out where he's going to fit in the company. We don't necessarily have a title for him, but he does a lot of the loose ends for our director of relations.
He's got the right attitude. He's one of those guys that
Yes.
that you met. It's just like, I don't know exactly what we're going to get him to do, but we want him.
Yes, he's exactly right. He reached out to us in college and said, "Hey, I'll work for free if I can have an internship." And he's one of those guys where he's super sharp, and we'll find a spot for him in the team. There's no question about that.
So Dan, when it comes to your company, your syndication company, your real estate investing business, what do you think is kind of your secret sauce? What do you guys do better or differently than a lot of the other syndicators out there, in your
Yeah,
humble opinion?
yeah, for sure. I think that
Yeah.
this is a touchy subject because, what we think we do better, another next indicator might be like, that's a huge mistake. So
Mm.
when I'm talking, obviously I'm speaking based off of our personal
Of
experience of what
course.
we've seen that works.
Yeah.
Yeah. So, one thing that we've definitely steer clear of is we don't get into any of the variable rate debt. And, during 21, late 21 and all of 21 and early 22, that's all that was being bought in multifamily was with bridge variable rate debt. And so our model has been fixed debt, and sticking to a low leverage fixed debt, somewhere in that 70 to 75% loan to value. And we have dabbled with it in the past with bridge debt. Luckily, we got into it late and got out really early and learned a really important principle that we changed in our company, and that's the way it's going to be moving forward. So that's been super helpful for us during these times, compared to some of these other syndication firms that are unfortunately losing some of their deals. Another thing that we found is super important for us in being unique is that we're looking for a very specific demographic and a very specific submarket. And the submarkets where we've done the best in is when we can find a property that cannot be recreated. So we're not competing with A-class property. It's a property that could be built between 1960 and 1975 or 1980 and an older asset that we can come in with plenty of CapEx dollars in the underwriting in the initial period, and we can have a product that our residents call home. I mean, when I was younger and I was in an apartment when I was in my early 20s, it was a stepping stone to buy a home like I'm in now.
Yeah.
And our residents, that's not how it is. It's their home is their apartment. And so we're looking for assets where home is for life and their apartment is their home for life. And so if you can find an asset where it's in a submarket where there's just not a lot of places for people to go, there's no new product coming on that competes with that type of demographic or that property type, and there's not a lot of units available in a submarket. We can figure that out by the occupancy. If occupancy is 96% plus or 95% plus, we know it's extreme pent up demand. And we've found that we've done and have a better job and easier job to move rents to market when we get into those types of scenarios. So we're always looking for assets in that type of scenario where you can move rents and there isn't a lot of options, where you have major demand and low supply. And if you can get into that scenario with a low leverage fixed debt and some conservatively average underwriting and not having to push it over the long term, you'll do fine. You'll do well, and you may even hit a home run depending on the market cycle. We're looking for base hits though. We're just looking for that steady Eddie cash flow position. Yep. Obviously get as much depreciation as we can, which is kind of out of our control to a certain extent, but get in that position where we're in a heavy cash flow position where we have plenty of CapEx dollars to fix up the asset and just hold the deal a little longer.
So if I'm understanding correctly, you're looking for markets where you can get into these, I don't know, would you call it kind of C-class buildings, a little bit older, a little bit outdated, that sort of thing, good occupancy. Then you go in, you fix
Yep.
them up, you bring them up to snuff, and then you also bring rents up to snuff, up to market value.
Right.
Is that the
Yeah,
gist of it?
you're exactly right. You nailed it. You're literally just moving rents to where the market is, and the market is figured out by a competitive secret shop. So you go and you secretly shop the comps, and you figure out where rents are at based on their amenities. And all you're doing is building a business plan to say, hey, we're looking to be the shiny little star after we implement our CapEx plan, our business plan,
Mhm.
after we add the value. Do we have the nicest asset in the submarket? And can we be in a cash flow position based on what the market's doing today? And so if you can make that work with low leverage fixed debt, we found that you can do pretty well in multifamily, and especially if you think a little longer term. I know tons of groups, tons of syndication groups in 2021 and early 22 got into this model of I'm in and out in 12 months or less, and I'm doubling and tripling people's money. And that may happen if you hit the cycle right and you've got the right debt and you're lucky, but that was just a cycle timing piece. And now the cycle's resetting, and we're in a totally different phase of the market now. And I think that if you can build a business plan knowing where you are about in the market cycle, mixed with the right location and the right debt, you're in a position where over the next 5, 7 years, you're going to do very well.
Yeah, and I notice, I mean, I've been interviewing folks for years now, and yeah, it seemed like a lot of syndicators is just all about the fees. That's how they're making all their money. And, they really, they were definitely not in it for the long haul, and just in and out quickly and churn and get into the next deal. And yeah, so I'm glad to hear that you guys are definitely much more long-term focused. Now, Dan, you've done an amazing job. You and your partner over the years have raised, I believe, over 100 million in capital. Um, what's some of the keys to your success with raising that kind of money?
Say the biggest thing is to just perform well on the stuff you have. If you can do what you say you're going to do and ideally outperform, outperforming was easy too. I mean, everybody was outperforming in 2020, 2021, early 2022, because again, the market was peaking, the cycle was peaking. But if you can be in a position where you can outperform what you projected all the time on the majority of your deals and be super consistent with your updates, every month at 7 o'clock a.m. on the first, you're going to get an update from us on
Yes.
exactly what happened over the last 30 days. And you're going to get the full set of financials. You're going to get the rent roll. You're going to get everything we get. And you're going to be able to see with pictures and with a very clear update where what we projected we would be able to do and how we actually did. We call it a variance report, and it's really easy to see within 3 minutes or less. You log in, take a look at this monthly update, and you can see, hey, did they do what they said they were going to do? Did they hit, or did they beat, or did they not do what they say they were going to do? So I think that's huge too. Just being super consistent with the updates. A lot of syndication groups do it quarterly, and I've seen some of the updates, and they're pathetic. You don't really know what's going on, which,
Yeah.
hey, that's totally fine. Maybe you have enough trust in your syndicator where you don't need that update. But we're a young company. We're still just getting going relatively. I mean, I've been doing this for 10 years, but Granite Towers is only 7 years old. And we're looking to be around for the next couple decades. So I look at us as still in the early stages of growth, and long term, just planning on being around. And it seems to me like those monthly updates and actually hitting your projections is the biggest thing to continually raise money and to have investors come back for repeat investments.
So what I'm hearing you say, Dan, is you do your best to under promise and over deliver, to
Yeah, yeah,
synthesize it, and then sounds like transparency with your communications. You guys internally are generating monthly reports to know what the hell's going on with your deals, and basically you're sharing that with your investors the first day of every following month. So it's really not probably not that tough. It's just a matter of doing that consistently because you've got the numbers already set up. Is that?
that's just it. What we
Yeah.
do is not that difficult. It's really not. You just got to have patience and be extremely detail oriented. And
Yeah.
if you do that and just take one step at a time and take the data one step at a time and make sure the data aligns, it's not rocket science. Literally, you're looking for a property in a submarket where demand is completely out of whack, where there's no place for people to go, where you can come in with a CapEx plan, which is your business plan, and recreate what's already been done and make it a little bit nicer with
Yeah.
fixed debt, and then move rents to what everybody else is already doing. And if that is a cash flow deal, we're in, and so that's really the name of the game. And then just being super open with how you're doing month after month after month.
Yeah,
And
transparency. Because you're telling me, it's not just the good news you're sharing. It's like, hey, if things aren't going exactly according to plan, which they never always do, letting people know about that as well. So being proactive versus reactive.
that's right. Yeah, we've learned some lessons, some harsh lessons, and at the end of the day, you learn them. You don't learn them again. You make them as principles. You be as clear as you can on the mistake that was made with your investors, and you keep going. And
Yeah.
I think that's how you become great at anything, And I think back to my snowboarding career. I didn't start at nothing and become one of the top pro snowboarders in a 10-year period, and it looked just perfectly like a straight line. There was pain along the way. And it's the same with this business. Anybody who's doing this, you're going to be a decade or more, go through a recession like we're going through before you really understand the business. And I think that's another thing that a lot of guys got over their skis, and their confidence got way too high, thinking they're these geniuses when really the market was just in a great time. And you got
Yeah.
lucky. You bought at the right time and you sold at the right time, and you thought you were a genius, but really it was just a cycle.
The good old high tide raises all ships, right? Yeah. So
Sure.
as we wrap up, Dan, I know that you and your partner, I think it's Mike. Yes.
Yeah.
Um,
Yeah.
have been running a podcast for a while. Tell me a little bit about your show and how that has helped you guys with your real estate investing business.
Yeah, our show is called Keeping It Real Estate. It is mainly around multifamily, but there is some mindset in there. We have had some athletes on, somewhat similar to my story, or we got a couple pro football players on with us. But really, it's about real estate investing and how to increase your skill level and knowledge of what to do. Because at the end of the day, what's the separator of someone who comes in and builds a multi-billion-dollar multifamily firm and someone who loses it all? It's what they know, and it's what they do on a day-to-day basis. So yeah, it's about education and helping others better understand how to understand when we got a good deal and when to invest and why. And if you're going to be a passive investor, what kind of questions to be asking.
Excellent. All right, Dan. Well, this has been great. Thank you very much for sharing some time with us and your experience and some really good nuggets there. That was, I admire what you and Mike are doing. If people want to find out more and get more Dan Brisse, what should they do?
Yeah, go to our website. It's granitetowersequitygroup.com, and there's a contact us button. Reach out to us. If you got any questions, we'd love to help and see if we can help, you build your wealth.
Awesome. All right, everybody. Thanks for tuning in, and we'll see you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.